Looking across bond markets, one area of the market that stands out to me is high yield, given the strong returns we've seen this year and since risk assets began to rally back in October 2022. It's also delivered that result with half the volatility of long duration treasuries. David, what's behind this outperformance?
Thanks, Nisha. Yeah, I think investors collectively are forward-looking, and 2022 was a really bad year for many riskier parts of the market. In part, values reset in anticipation of recession. So I think what we have seen this year really has been recovering from those marked down prices. So that makes sense. That's logical. We all know the disconnect between tech and the rest of the market in terms of global stock market performance. Really, that's a similar pattern that we've seen play out in bonds too. And just as there has been significant dispersion in the S&P or Nasdaq, so too there has been in high yield, as you mentioned. So, for example, the lowest quality part of the high yield market, so that's CCC rated securities and below, have risen around 11%, or had done to the end of September. And that was easily double the return of a better quality double B, single B rated security equivalents. Statistically, companies with that type of rating, with CCC type rating, are most exposed to the economic cycle. So slightly better than expected growth was combined with those still low by historic standard debt service costs to prevent a surge so far in default and distress. Also, low-rated companies performed shockingly badly in 2022. So that same index was down about 16% in total return, something like 25% in capital terms. So much perhaps of the performance is, as I mentioned, due to that prior mark-to-market losses being recouped, a market that was perhaps oversold, now coming back more toward fair valuation.
Okay, so what I'm hearing is that there are stark differences in the risk return profile between higher quality high yield bonds and those that are rated CCC and below. How do you go about mitigating some of those risks?
Yeah, that's a good question. The easiest way to mitigate is basically to avoid them. I think if we're really honest here, CCCs and lower down 16% 1 year, up 11 to the next, really doesn't make for a sleep easy portfolio. My co-manager Alex and I aren't convinced that that type of pattern of return is what people really want from core bonds. So it's no surprise then that we are actually going to avoid CCC and lower in our mandate. That's the feedback that we've had from a number of prospective clients. We can't promise to entirely remove volatility from the portfolio, of course, but avoiding or restricting investment entirely to those lower parts of the market to certain areas certainly should mitigate some of the more extreme moves that investors could otherwise be exposed to, even in a traditional lower risk sector such as the strategic bond sector.
David, so far we focused on high yield, but what other parts of the credit market are capturing yours and Alex's attention?
Yeah, I say Alex and I still do like certain parts of the market. However, the overall level of compensation from investment grade or high yield generically isn't really worth getting too excited about. There are geopolitical and economic risks aplenty, plus risk-free rates have risen, meaning that the extra income from a credit portfolio as a percentage of your total return is much less than it was maybe 2 or 3 years ago. I suppose one way of thinking about it is, why chase 7% when you can readily find 6% in a fund of liquid quality sovereign and investment grade names? So at the moment, we'd have less credit with better rating and lower duration than we'd expect to own on average. As always, though, the devil is and will likely be in the detail.
Thanks, David. So given market dynamics, it's clear that a quality and a fundamental approach within credit will be key to navigating risks, but also seeking those investment opportunities. We hope you enjoyed today's episode. Thanks for joining us and have a great rest of the day.